Hey everybody, welcome to Trading Capital's daily analysis video. It is here on this Wednesday, June 8th, 2022. Jumping into the S&P 500, overall the big indexes, the S&P and the QQQ, have been under pressure all day long. We are closing down on the day today, but we're still stuck in that we're range bound. Essentially, we've been range bound for the last week, and the range continues. Now, it is still bullish consolidation when we flip to the daily chart, but on an intraday basis here, you can see we opened up, sold off a little bit of pre-marketing or in pre-market, and basically came back all the way up, made a little bit of a short-term intraday high, and then sold off all day long. So right now, we are into a little bit of support. You kind of saw a little bit of a last-minute pop. But the thing about this type of pop here is it's happened on extremely light volume in the S&P 500. And I think one of the reasons why we're seeing extremely light volume is for one simple fact that the markets are currently waiting for the inflation news. And I think depending on how that data comes out, I think that's going to be what causes us to break out of this intraday bull flag pattern. If inflation expectations come in lower, then I think the markets can rally. However, if inflation still is peaking and comes in higher than expectations, I think the markets can continue to fall a little bit lower. And honestly, if it's that happy medium number, markets can probably still look to rally as well. But if inflation comes in hotter than expected, it will mean that the Fed has to probably continue aggressively tightening. I do think we still get that 50 basis point hike. There's no real doubt in my mind. That is for sure something that is likely going to happen. So I don't really see, inflation really affecting what the Federal Reserve's plan and how hawkish they're going to be. Maybe if inflation is still a little bit higher, their language that they use might become a little more hawkish, and we have clearly seen that the Federal Reserve used English as a language, English as a loaded weapon. So that's realistically how they're accomplishing their economic policy plan, is by using a lot of hawkish talk to drive assets in a certain direction, or dovish if they're wanting to be more of a accommodative Federal Reserve. But still consolidating bullishly, stuck between the 25 and the 50-day moving average. You have this pivot low as resistance, as well as these pivot lows. Ultimately, I'm still in the camp that it does favor a move to the upside. I would definitely like to see this key technical gap filled around the 429 level. So we'll just have to keep monitoring that on a daily basis. But realistically, it's not a real bad day for the markets. This pausing and consolidation is actually healthy, and there's potentially a short-term day trading opportunity to play maybe tomorrow or on the inflation day on Friday when the CPI does come out, because this bullish consolidation is certainly priming the probabilities for an up move. And remember how we were talking about that inverse head and shoulders yesterday on an intraday basis? So that would be this left shoulder here, your head, your right shoulder. Well, that has kind of failed at this point in time. You did have a short-term breakout over here. Let me just make this a different color. But now that's failed because you've closed back below on an intraday basis, below the neckline. So that inverse head and shoulders has been negated. It was kind of an immature pattern, just the way that this left and right shoulder was formed. But you can see that this is a beautiful channel that we're filling, and we're just consolidating, waiting for that economic data to break out of this range. The QQQ realistically pretty similar. It's down just under 1% on the day, 0.76%. Same sort of deal with the NASDAQ. You're consolidating between the two key moving averages right underneath this resistance line, and you do favor a move up to these pivots. I do think, since this was the original breakdown zone on this impulse candle to the downside, I do think that you move up to at least touch this 317 mark. That may coincide with the 50-day sloping down as well. That could be a great area to potentially short. Now, if for some reason yields fall a little bit faster on lower than expected inflation, it can give the NASDAQ a little bit more of a boost potentially, and I say potentially up to this 328. level. We'll just have to wait and see. We did add to our cat position today. This is our second addition to the short position. You can see that we added right at this gap fill over here around the 231.48 level, and it has pulled off of that level quite significantly. So right now our average is sitting at 222.26, which I'm actually very, very comfortable with, because it's now considered to be, our average is now outside of this wedge pattern. And I do think with a slowing economy, especially since the World Bank revised down the global GDP forecast for 2022 by 1/3, a whole 33% revision down, that should put pressure on all of the economies globally, because that's a global outlook and forecast, and a revision of down by 1/3 is quite substantial. And that's what the trend we see in all the signals and the risks across real estate, the bond market, inflation, equities, you name it. Everything is pointing to a recession, and the fact that now the World Bank just came out yesterday with a revision down of global GDP, that just supports and strengthens our thesis that we will see a recession here in 2022. A lot of people don't think we're going to see it in 2022, but I certainly do. I'm in the camp that we do see that recession come sooner rather than later. So that was a beautiful add thus far. We have plenty of maneuverability for increasing our Caterpillar short exposure in the event that it does go higher. But nonetheless, I do think this will be a tremendous shorting play for us once that recessionary fears take hold. If we take a look at natural gas, it was up on the day, made a new fresh high during the cycle, and then it completely reversed later in the day. There really hasn't been that much news for natural gas. We did get the EIA crude inventories out, and natural gas EIA inventories are out tomorrow. So I'm kind of speculating here that some big players have had a leaked look at the EIA natural gas inventories, and that's potentially why we saw this big reversal dump. And it kind of makes sense that again, it is an overbought condition, so this could just naturally be a pullback. We did fill a technical gap here, but I'm still expecting a build in the inventories come tomorrow at 10:30, which should put some more underlying pressure on natural gas, and it should help our short position. But it's good to see that natural gas had a nice sell, and this is the type of action that natural gas has. I just want to flip to the hourly chart. This sell-off happened in 1 hour. It just shows you the sheer power of natural gas. When it does start to fall, it really starts to fall. And this isn't even coming on the back yet that we're in a full-blown recession. I can only imagine once the mainstream gets a hold of the recession word and starts to pump it out there, that the narrative for energies will start to fall. And people say the energy bull market is too strong. That's what people were saying in 2008 as well. And yes, we are in an energy bull market, whether it's oil and natural gas. But the biggest thing that drives energy prices higher is what the global or country's GDP is forecasted to do and is doing. So essentially, economic growth of a country is going to be the biggest fundamental driver for energy. And when growth slows and people are consuming less goods, less services, oil, energies always take the biggest hit in the market. And that's certainly what I'm expecting over the coming months for the energy market. So we'll just have to continue watching natural gas. You did fill this key technical gap and kind of hit this 25-day moving average. I don't think we're going to resume higher and continue. You could get a small retrace, maybe a 50 or a 60% retrace of this candle tomorrow. But I do think with strong build numbers tomorrow, we could see more further downside in natural gas. If we flip to the UNG, let's just take a look at the UNG here. The UNG, again, what a nice sell-off as well. Let me just erase that. So again, you filled this massive key technical gap. The next gap I'm looking to fill is this 2483 level. That'll be a beautiful, beautiful sell-off if we can get some continued downside pressure on UNG. Let's just flip to the weekly chart on natural gas. Again, if we flip to the weekly chart on natural gas, you can see here that, again, there's still 2 days left in this week, but you're starting to form this beautiful weekly topping tail. If we can get another weekly topping tail on natural gas, that would be an excellent probable sell signal that the top, or at least a short-term top, is in for natural gas. So let's just keep monitoring that. If we take a look at oil, oil had a pretty strong day today as well, up over 2.2%. This came on the release of the EIA petroleum status report. Essentially, the markets, there was a couple drawdowns, a couple builds across different oil sectors there, but overall, oil caught a bid on the fears that we're depleting the strategic petroleum reserves too quickly, as well as the effects of poor energy policy in the United States of America is driving oil to go a lot higher. And one of the interesting things that I want to bring to your attention is that we are now currently on month 3.5 of having oil above $100 a barrel. And in 2008, the economy crashed after oil held above $100 a barrel for 4 months. So we're approaching that time frame, that very similar time frame where that demand destruction really starts to occur. I believe it's already occurring just with the price of gasoline and other input costs for businesses. So I do think that demand destruction is currently occurring. There's been some speculation in the industry that the demand destruction will only start occurring at $160 a barrel of oil. I don't even think the oil will get to those levels in this cycle due to the fact that the demand destruction is currently happening right now. This is why companies are revising down sales, profit growth projections. GDP is being revised down because the demand destruction is currently happening already. And with China back online, it is giving oil a little bit of an underlying bid. But I do think that will wane over the coming days as the markets generally price that in pretty quickly. If we take a look at the weekly chart of oil, let me just flip to the USO. So let's take a look at the weekly chart of the USO. You can see on the USO we had 1, 2, 3, 4, 5, 6, 7 weeks in a row of upside. So this is why I added to my SCO short, our oil short today, just another 1% addition, taking our holdings up to 3% net short oil. And you are coming into this resistance here, this pivot high to pivot high to pivot high. So since you're into resistance, you're also on a nice time count. I did think it was necessary to increase our oil short exposure, especially since now the oil data is out. There's really no more surprises in the oil industry unless some crazy catalyst or hurricane happens, whatnot, that the markets have not priced in yet. So I do expect oil to eventually come down, especially as the Fed begins to aggressively tighten more and more. And with the midterm elections coming up, Biden doesn't stand a shot in hell, and his polls are down because inflation is running rampant. If this guy really, really wants to have a shot at helping his party, the Democratic Party, then he's going to have to get a grip on oil, and he's going to have to really start to rethink some energy policies, because what they're doing is handicapping the United States of America. They're not even thinking about the future. This is regressing the United States of America from building a healthy, cleaner, greener future, because the amount of demand destruction and wealth that they are destroying on a daily basis by allowing their citizens to pay for this high gasoline prices, oil prices, products is just downright lunacy. It's really, really not well thought out in from their standpoint. Let's take a look at gold. Gold's just holding again here, not really doing too much. It is kind of forming a little bit of this bullish pattern. potentially wanting to break out. You are still holding above the 200 and this 25-day moving average, so that is healthy to see. Gold is kind of just lagging due to the fact that the US dollar was up today, but it's good to see that gold is holding some of its gains. It's kind of a flat day today around 1850. It's trying to build a base off of this 1850 level. Once we break out of this a little bit of a bull flag pattern, gold can definitely move up to this 1900, 1910 area, and that would be a pretty good move for gold for the short term, and look to potentially consolidate and digest that move up as well. Let's take a look at silver. We are long silver still, so the SLV, we are in the money. Silver, very similar to essentially silver is down on the day today, but you are holding above this key short-term moving average as well. You have been stuck under this resistance trend line over here, so we'll just have to monitor that. That's going to be your big level. If you can break through that, then I do think you come trade back and test the low range of this channel. So this was the channel that you were chopping and trading in, and then you broke. So naturally, I do think you come back to retest the original scene of the crime where you broke down. So this is where you broke down, and this is where I think you come and retrace to at the minimum for silver. But we'll just have to monitor silver. I may close our silver trade out sooner than gold. One of the reasons I'm a little bit skeptical about our silver trade is for the one simple fact is that I've noticed silver isn't moving as much like a precious metal asset anymore. It's being heavily dominated by the industrial side. So since I am on the side that the global GDP is slowing and economic conditions are turning unfavorable, I do think silver's industrial side does take a hit, especially as the big cap tech and the semiconductors and vehicle makers slow down with a slowing economy. So I may cut silver faster rather than and hold on to our gold position, but we'll just have to keep monitoring the price action. I am a little skeptical that if the recession word starts to take hold in the media, silver could be hit really, really hard. So I'm monitoring that very closely by the day to see if I'm willing to hold it a little bit longer or cut it and potentially buy a little bit lower. Because if that recession does take hold, I do think silver will come test this 1950, 1960 area, and it could potentially come lower. That's for sure. But when you see types of sell-offs like this, and without a recession, taking hold in the media, something like this could happen again with silver very, very quickly. So we just have to be nimble around our silver position. If we take a look at the US 10-year, it was up today a little bit. So if we just take a look here, you had your reversal candle here. You've had a retrace. You haven't taken out that high over there, so that's a short-term bearish signal, but nonetheless, it is holding around the 3% mark. And I still think yields roll over, but give it some credit. It is holding above this 3% mark. And I think the reason it's holding above this 3% mark is this is a little bit of a short-term sign that the bond market could be potentially pricing in a higher than expected CPI read. So I think yields will make a move pretty quickly on Friday along with gold. I think Friday is going to be the big day around 8:30 when we get the CPI number. There's a lot of assets that have been stuck in a range, whether it's yields, gold, silver, Bitcoin, the S&P. There's many different assets that are stuck in a range, I think just waiting for that economic data to be released to eventually either break up out of the range or break down and start forming a new range. So tons of things are going to happen on Friday, in my opinion. I do think the CPI will shake things up. So that's obviously going to be the big talking piece of the day in terms of what the CPI number does and comes in. If the CPI comes in hotter than expected, expect yields to push up higher. If the CPI comes in lower, expect yields to fall. I'm still in the camp that the CPI does start to come down and wane a little bit. I don't like to throw out in terms of what my forecast is for the CPI, but I do think it should start to wane a little bit as I do believe we've reached that peak in inflation, despite energy still going high. And one of the reasons if energy is made up a higher component of the CPI, I would certainly think that the CPI would move higher based off of the fact that how high energies are. But since energies don't incorporate much weight in the CPI basket, then I do think the yields will push a little bit lower on the charts. Let's take a look at Bitcoin. Got to pull up my Bitcoin chart here. So Bitcoin is currently trading at just around above 30,000, and that's really the key area that we're watching. Really, it's been a chop fest for Bitcoin. It's one of those assets that, again, is also stuck in the range. I think it's waiting for that, obviously, that CPI release to really start breaking out and forming a new range. But it is getting long in the teeth here. If we don't see a break up to the upside very, very soon, then this bear flag pattern, this long-term bear flag pattern over here, that's going to start taking hold of the pattern. So we really need to see a move up before in the coming days in order for Bitcoin to stand a chance at breaking up and pushing to the 34,000 and then the 35,000 potential level. That's it for today. Thank you again for being members and subscribers. Please give this video a big like and thumbs up. If there are any specific stocks you want me to analyze, feel free to leave a comment and a like below. Take care, everybody.